Thank you, everyone, and welcome to Introductions to Financials. Thanks for joining us. As you might know, this is part of our Integral Intro series where we present overviews of areas of expertise that IntegralOrg provides. That ranges from nonprofit governance, legal compliance, risk management, and of course, financials. My name is Liz Tang. I use pronouns she, her, and I'm the program coordinator for IntegralOrg. I'll be around hosting, monitoring the chat, and any tech support you might need. So without further ado, we'll just go into our land acknowledgement. So we acknowledge that what we call Alberta is the traditional and ancestral territory of many peoples, presently subject to Treaties 6, 7, and 8, namely the Blackfoot Confederacy, Kainai, Piikani, and Siksika, the Cree, Dene, Saulteaux, Nakota Sioux, Stoney Nakoda, and the Tsuut'ina Nation, and the Métis people of Alberta. This includes the Métis settlements and the 6 regions of the Métis Nation of Alberta within the historical Northwest Métis homeland. We respect the histories, languages, and cultures of First Nations, Métis, Inuit, and all the First Peoples of Canada who have lived in and cared for these lands for generations. And we're grateful for the traditional knowledge keepers and elders who are still with us today and those who have gone before us. We make this acknowledgement as an act of reconciliation and gratitude to those whose territory we reside and work on today. So I'm very happy to introduce our today's facilitator. This is Stella Penner. She has decades of experience providing financial reporting and governance support to charities and nonprofits. Previously, Stella has held various roles in professional development and as a full-time instructor in financial and management accounting, audit, finance, and organizational design and analysis at universities and colleges in Edmonton and Calgary. And she has also executive experience as the prior CEO of FCGA Alberta.
Thanks, Liz. It is so good to meet, quote unquote, all of you. I'm just so glad to be part of IntegralOrg and to be able to present to a group such as this. So as Liz says, I've done a lot of both hands-on and oversight around financial areas for not-for-profits and charities. And so I notice a lot of you from the participant list are with charities. And so I certainly have a strong inclination to serve that community. What we will be looking at today is really high level. And so I'm going to start off talking about the roles of the different participants in the financial reporting life of an organization. We'll look at, again, 1,000-foot overview of what kind of financial information does a board need to make good decisions. We'll look at the purpose of what is called internal controls. Of course, we're going to focus primarily on financial controls, but we will talk more broadly about what the whole point of having internal controls is. And then the last topic we're going to cover is what is the connection between budgeting and internal controls. So that's sort of a map of where we're going for the next hour. So before we look at these 3 roles, I want you to know and be aware, as you no doubt are, that in addition to these 3 roles, there's also senior management or the executive director or CEO of the organization also has a critical role to play in finances and financial reporting. But we're focusing on 3 key roles that are part of that financial reporting cycle and sort of who is responsible for what. And this is kind of difficult sometimes because there isn't, you know, even though I've got a lovely chart with 3 columns, it's not that clear because every organization has slightly different roles and responsibilities. They may have a little different governance structure. A board may be very strictly a policy governing board versus more of a management hands-on board. And so what your governance structure is like will have some effect on what these roles, but so these are just very broad oversight or overview of what the roles are. So the board has oversight responsibilities. As the board of a nonprofit or a charity created, registered, incorporated in Canada, the board has fiduciary duties. The board is like a trustee because they're looking after somebody else's resources. whether those are donations that came from others, grants, or so on. The board is not dealing with their own money, they're dealing with the funds given by the donors and the contributors, and have a stewardship responsibility. So boards, I found, sometimes get more excited about dealing with programming and about achieving goals and so on, and they don't want to deal necessarily. It's no fun dealing with the finances, and we'll let the treasurer look after that. The board cannot delegate away its ultimate financial fiduciary responsibility. And so that is critical to oversee, maybe not do, obviously the board isn't doing the financial work themselves, but to know that somebody is getting it done. The board has the responsibility in planning ahead and setting priorities and direction for the organization, and that has a huge impact on where you choose to spend your money. Boards also have responsibility in risk assessment, and again, making sure that the people that are doing the work, whether that's the executive director and his or her employees or other volunteers, are mitigating risk to the extent that it's possible. And then all three parties have a responsibility in monitoring, but at different levels. So the treasurer role, I find, is defined very differently from one organization to the next. But in most cases, the treasurer is appointed by the board, often is a board member, or usually is a board member, not always, and basically acts as a liaison between the board itself or the finance committee and the staff that are in the financial area. And so they provide expertise both to the board to help them interpret financial matters, but also provide some advice perhaps to the CEO who may not be a financial expert. So the treasurer very often has a responsibility in both directions to advise and consult with both the board and with staff. The treasurer also often is the main liaison between the board and the external auditor, if your organization has an external auditor, and so has some responsibility there around year end to make sure that the auditor gets the information that they need and that the board gets the information that the auditor needs the board to get. And then finally, the organization will have somebody who actually does the accounting. And that might be a small organization, may have a part-time bookkeeper or a freelance bookkeeper, all the way up to a very large organization will have a controller reporting to a CFO. But in this context, I'm looking at the hands-on people that are recording the transactions. And so they would normally report to the senior staff officer, whether that's a general manager, executive director, or whatever that person's title is. And they would provide financial information to their boss, the executive director, to help them make good financial decisions. Other times they would also be sourced as the staff support for the treasurer or staff support for the finance committee. And again, that structure varies very, very much from one organization to the next. When the audit gets done at year end, the bookkeeper or the accountant or the controller, whoever that top level person is in the accounting group, would be the main liaison with the actual staff on the audit team of the company that's doing your external audit. So very different roles and responsibilities, and again, varies a lot from one organization to the next. But here's a general, when I'm talking about board, treasurer, or accountant, these are the three roles I'm referring to. So what kind of information or financial information does your board need? We're going to look at sort of three purposes of financial information. There's one set of financial information is where are we now, where are we going, and then how do we plan and monitor using financial information. So the first set of information, which is about where are we now, is a fairly standard package of financial information. And some organizations prepare this monthly, some prepare it quarterly. And so I would suggest that management would need this information as a minimum monthly, but the board of directors may only need this information quarterly, depending on how dynamic and how seasonal financial operations are. Quarterly may be sufficient if you're in a very sort of stable situation rather than monthly. The statement of operations is also called the income statement, and it shows the revenue and the expenses of the organization and tells you for the period whether you had more revenue than expenses. Simple, right? The other thing that we use to see where are we now in most organizations is not just the income statement on a standalone basis, but compared to budget. And we'll talk about that more again when we're talking about budgeting. And then a report that I believe boards need and management needs to assess where we are now financially is a balance sheet, a statement of financial position. A lot of boards don't ever see the financial statement of financial position until year end, and then they look at the annual one. I would suggest that it's a valuable report and should always be included in the package because it tells you sort of what your obligations are. It tells you how much money do you have in the bank, how much do you have coming in, and how much of the money that you have in the bank or is coming in, your receivables, how much of that is actually available to be used and how much of it is restricted. So that information is presented in conjunction with the balance sheet, and that's why I think it's really important. Often organizations say, oh, wow, we've got $1 million in the bank, or we've got $200,000 in the bank, and they forget that, wait a minute, of that $1 million that we have in the bank, 990,000 of it is already committed to a specific program, so it's not available to us. And so by including the balance sheet and some sort of a summary of what your restricted cash is, it gives a better picture of where we actually are right now. The next group of financial information that a board needs is information that helps them assess where are we going. And so starting with a strategic plan and priorities, it gives us information about where we're going. And if we have priorities, how are we going to spend our resources or direct our resources towards our priorities? So if our priority, let's suppose we have an organization that serves adults, children, and does some sort of public advocacy work, which of these is our priority? Where are we spending our time? Where are we spending our money? And so the strategic plan will help guide that. And I think of the strategic plan priorities and the capital asset life cycle plan as long-term financial information. It looks ahead 3 to 5 years. With the capital asset life cycle plan, it may look ahead even more than 5 years. So that's a long-term financial information. Then I always recommend that organizations not only look at a 1-year budget, but do some sort of a 2 to 3 year cash projection or financial projection so that you can see how this year is going to fit into that long-term plan. Maybe we've got a big capital expenditure that's going to be required in 3 years. Well, do we have the reserves being built up to meet that? Or maybe we're planning to expand our programming in 2 to 3 years. How are we going to build up the resources necessary to do that long-term or mid-term plan? And then, of course, the one that we're all familiar with is the current year budget that is based on our action plan of what we're going to do in the forthcoming year or in the current year. So financial information on 3 different time horizons, I think, is useful. And then the last set of financial information that we need is, first of all, planning, as in the budget, and then monitoring. So financial information is critical to seeing what's going on, to providing those checks and balances, and creating red flags when there's problems coming. So monitoring, are we on track? Are we going down the wrong path? Are we running into trouble? And one of the big pieces of that, of course, is comparing your actual results for a period of time to what you had planned to spend in that period of time. So an actual to budget comparison, but not in a vacuum. So the actual to budget comparison might include with it, or should include with it, explanations of why are there variances. So for example, I had an employee that was supposed to do a certain amount of public relations activities in a current period, and so had budgeted for X number of visits to stakeholders within a period of time. And at the end of the first quarter, second quarter, wow, his budget was way under actual. So he thought he was really doing well because he had budgeted like $20,000, but he had only spent 10. Wow. And he was expecting a pat on the back because what he saw as a positive variance, I said, no, I need an explanation. Why do you have a positive variance? That's all fine and good. But it turned out that he had only made half as many stakeholder visits as had been part of his original plan. So the variance explanation in that case was not a positive as far as his performance was concerned. And what that did, once I got that explanation from him, it gave us a chance to plan. Well, how are you going to make up that difference? How are you going to get those visits in? And so it turned out it was a seasonal issue. Some of the stakeholders simply were not available earlier in the year. And so he revamped his monthly visit plan, started sending out invitations, and ended up the end of the year almost finishing his plan, and the costs were equal to the budget. Now, if that variance had been because he had found cost savings, he was driving rather than flying, yeah, that would have been great. It would have been very nice to know that he had actually fulfilled his plan, but managed to save money. So those are two different things. The other thing about the variance explanations then is the board can ask management, okay, you've got a positive variance here. What are you going to do to fix it? You've got a negative variance here. You're spending way more money on X than you had planned. How are we going to find the money to cover that shortfall? Or what kind of savings are you going to find to cover it? So the planning and monitoring by comparing actual to budget gives you a chance to forecast to year end and react to changes and come up with a plan to deal with shortfalls instead of having them surprise you after the fact. A lot of planning and monitoring is done by exception reporting. So with a very detailed budget, a board doesn't need to see every place where something is $10 off budget or $20 off budget or even 1% off budget. So the board may have an interest in knowing where things are significantly different from budget or where something unusual has happened. So a program had to be canceled. A pandemic happened, so we had to shut all of our in-person training. So if we don't need to know when things are going according to plan. We want to know when they're not going to plan and what are you doing about it. And then the other thing that comparing actual to budget will help with communicating is whether our plans and policies are being carried out. So in my example about the employee who was not fulfilling his PR plan or his visit plan, by looking at the budget, that made it obvious that his plans were not being carried out, and we could explore why and figured out how we're going to address that. I'm just going to check with Liz. Are there questions related to these three pieces of information that boards need?
Thanks. We do have one question.
Okay.
May asks, what would be the difference of the board role when you use the John Carver policy governance, and does their financial responsibility change?
The thing that doesn't change is their legal and fiduciary responsibility to oversee financial health of the organization. So that is something that comes from incorporation law, societies law, charity law, and so on. The board has a fiduciary responsibility to care for the contributions and assets provided by the funders. And you cannot delegate that away. What you can delegate is the details. And so the way the Carver governance model works is the board fulfills its fiduciary duties by giving parameters to management within which they must operate. You are not allowed to run a budget deficit, for example, might be a parameter. But then the board also has a responsibility under Carver, if they've given the CEO the limitation of you are not allowed to run a deficit operating statement, they need to verify that that's actually happened. So the CEO would provide reports to the board as evidence that they are complying with the parameters that the board has laid out. So the responsibilities are still the same, but the techniques that the board uses to exercise that oversight is different under different models.
Cool. That was our only question from the chat.
Okay.
Yeah.
Okay, then let's move on to the next burning question, which is about financial controls. So I want to start off and provide a bit of background or context. So the heading on the slide says financial controls, but I want to talk first more broadly about internal controls and what is the purpose of internal controls, and then we'll focus on those that affect finances. So the purpose of internal controls, if you read any finance or business textbook or audit or accounting textbook, internal controls are those policies and procedures that are implemented by management to ensure that their policies and plans are implemented. So they're not there to be a policeman or anything like that. Controls are a tool for implementing management purposes. And so we're going to focus narrowly on controls around that affect financial areas. But often when you hear internal controls, we start thinking about big, scary things like, fraud or theft. And that's really only a narrow part of internal controls. So if you ever go to a public washroom and you see a sign like a chart where a person has signed off every 2 hours or 3 hours or every day that they have inspected the washroom, that's an internal control. So the policy is the washroom gets checked or cleaned every 2 hours. The chart on the wall that the employee has initialed is the internal control that makes sure that the policy is being enforced or is being implemented. So obviously internal controls are much wider than financial things. So just be aware that the first purpose or the primary purpose of controls is implementation of policy and plans. And how does that get done? Because management cannot follow every employee around all day long, making sure you're doing what you're supposed to be doing, or making sure you're implementing our plan or sticking to our policy. So controls are the things that help management make sure those things are happening without having to do hands-on, in-person monitoring all the time. So the key purposes besides implementing management policies and plans is protecting your assets, mitigating risk, ensuring that efficiencies happen, and then monitoring whether these things are going on or not. So we'll look at examples that fall into these different areas and achieve these different purposes. So again, internal controls, we may think of very specific things, somebody re-adding a total or somebody, putting it, double checking their colleagues' work. Those are definitely internal controls, but there are also controls that are more general and wide and affect and are implemented across an entire organization. And then there's specific controls. So we'll look at types that fall into both of these categories, and be aware that any control, whether a general control or a specific control, might be designed to prevent something from happening, or it might be designed to find something that happened that shouldn't have so that it can be corrected. And then another control may be in the nature of separating of duties. So that's making sure that there's no conflict of interest between multiple steps in a process, so that people don't have the opportunity as much as possible to cover up their own mistakes. So let's look at some controls that fit into each of these types. So entity-wide, our general controls are hiring the right people, getting the right volunteers in place, having a system to vet both volunteers, and making sure that you do reference checks when you're hiring people, having clearly defined roles and responsibilities. I am just getting involved with a new charity that's thinking of establishing operations in Calgary. They're a Canadian organization without a presence here. And the first thing I had to do was get a police check done to make sure that I had no criminal record. So that's a pretty basic thing. And in many roles that wouldn't be relevant. For this particular organization, it's relevant. So hiring the right people that are honest and conscientious and suited for their particular role is a form of control. Because if you hire somebody to be the accountant that has never in their life managed their, a set of books before because they're, the cousin of a friend, or they really need a job, I'm sure they can figure out the books. That's probably not a good internal control. So knowing your people. Another important part of entity-wide controls that's harder to define, but easy to recognize when it doesn't exist, is having the right tone at the top. And so tone at the top is conveyed by, in the context of controls, tone at the top is conveyed by how seriously does senior management take controls and policies? How clearly does the board take policies? So I remember an organization I was on the board of, and I was quite surprised after being on this board for a number of years to find that they had a policy that they do not pay for alcohol at meals. I had never been at a board meal where we didn't have alcohol. And I thought, wait a minute, that's not really right. If we're going to forbid the staff from ever paying for a single drink, why is it okay for the board to have pay? To me, it didn't set the right tone at the top. If it's good enough for the staff, it should be good enough for us. And so policies around travel, classifications, and so on were not enforced at the board level. And so to me, it didn't set the right tone at the top. And so my shorthand for that is lead by example. Be a good role model for everybody and don't expect special consideration because you're the boss or because you're on the board or something like that. Another set of entity-wide controls are around information and, basic things like password rules, enforcing password rules, monitoring them, making sure that private information, confidential information is in fact kept confidential and not accessed just out of curiosity. I think you may remember a story from a few years ago where Alberta Health Services employees were fired because they had accessed health information of an acquaintance, I think it was. I don't remember the exact, but it was anyway, someone that they were not treating as a patient, but they were looking out of curiosity. And so you want to make sure that access to private information is protected so that only people that need that information would have access. And then having clear policies, including value statements, you might call it a code of ethics, a code of conduct, conflict of interest statements, and so on. And ensuring that when you orient new board members, when you orient new volunteers or orient new staff, that they are taught and know what those value statements are. I recently did a project where I assisted an organization with updating their financial policies manual. I said, I'd like a copy of the organization's code of conduct because I wanted to make sure that the policies were in alignment with their stated code. And it was around a conflict of interest question. And it turned out that they didn't have a code of conduct, I thought. When I took the question up the chain, it turned out they did have a code of conduct, but it was like tucked away on a shelf somewhere. employee, the people that developed it assumed it applied only to the board and didn't really think in terms of, well, this applies to employees also. So by having that culture at the top, where everybody takes policies seriously, management is not consistently asking staff to override policies on their behalf, saying, well, I'm the boss, I can do what I want. Those kind of things create an environment of the organization taking these things seriously. It's not on the slide, but another policy that I would suggest nowadays that if you don't have, you might want to consider as an entity-wide policy is around use of social media. If employees are identifying themselves as employees of the organization, are you putting any limitations on the kind of things that they can opine on social media? Because some organizations have got into trouble because they had no policy on this. The next group of controls is the ones that you probably think of. So when I say financial internal controls, these are the kind of things that would probably come to mind. If you don't have the former set, if you don't have those general controls, the tone at the top, management taking these things seriously, then these specific controls are really not very effective. Because if you have a control that, so-and-so must approve this kind of transaction, and then management says, well, I'm going to sign this check anyway, even though that person didn't approve the invoice. And if that happens too often, then the approval on the invoice becomes meaningless, because like half of the invoices, and I mean, as an auditor, I would see many, many examples of this, where you had a policy of a particular position had to approve a particular transaction, and we'd look for evidence that they had been approved, and 50%, 80% had no evidence of approval. And so it showed that there was not a serious consideration. These policies were not taken seriously. And if you don't take policy A seriously, how can you assume that you're taking policy B seriously? So let's look at each of these a little bit as to what they mean and what the benefit is and how you would put them into place. So I think in any organization, no matter how big or how small, that having a clearly understood and clearly followed process around completion of bank reconciliations is just absolutely a bedrock control. No matter how small you are, even if you have just one bank account with, that puts through a few $1,000s a month, that bank account needs to be reconciled on a regular, timely basis. I would usually say monthly. I've run into a few volunteer organizations that turn over just maybe 5 or 10 transactions a month. In that case, maybe keeping an eye on the bank statement and doing the reconciliation quarterly would be sufficient. But no, the default would be monthly. I've worked in organizations where I required the staff to do a bank rec weekly. And don't mock, don't say, oh, don't shake your head. It's actually way faster. If I had an employee who I pushed and pushed to do her bank recs weekly instead of monthly, and she pushed back, she resisted. So finally, I brought them up to date to the end of the prior week. I said the next Monday, okay, do the bank rec to Friday. And she said, oh my goodness, that only took about a quarter as long as usual. And I went, yeah, and it's going to go even faster. And so a job that had been taking her half a day a month, so 3 or 4 hours a month, she was able to reduce to 10 or 15 minutes a week by doing it every week. So, and it meant that the reports, I gave weekly reports to management in that particular case because of some of the program had weekly cycles, and it enhanced the accuracy. So the bank rec, first of all, ensures the integrity of the finances, that the checks that are going through the bank are the ones that you issued. It gives you an opportunity to find certain types of fraud It doesn't guarantee that you'll find them, but it gives you the opportunity to find certain types of fraud. It enhances the accuracy. So you may have thought you issued a check for $1,000, but inadvertently there was an extra zero added, whoever typed the number in, and it was a $10,000 check. So again, doing the bank rec gives you a chance to find those errors and correct them. And then because it is such a key control, if you're not doing this already, I would implement this sooner rather than later, is that a second person reviews the bank reconciliation. And I didn't want this course to be really detailed, but this is such a key control that I'm going to explain what I think is necessary when the bank rec gets reviewed by a second person. So the person who prepares the bank rec, let's just say that's the accountant, whether that's a bookkeeper, controller, whatever. So the accountant prepares the bank rec. And let's say you don't have other senior staff with financial expertise, so the treasurer will review the bank rec. And so what the reviewers should be looking at is they should get a copy of last month's bank rec, or last week's if you're doing it weekly. So they should get a copy of the prior bank rec, a copy of the bank statement, and then a copy of the current bank reconciliation. The reason you want to look at last month's bank reconciliation is you want to see whether things that were outstanding last week or last month have cleared. So if you see a deposit or an adjusting entry in January that is still on the bank rec in February, that's a red flag, because it might make sense that the occasional check recipient, especially with small checks, may not get around to depositing and clearing it. But if deposits are not clearing or adjusting entries are not clearing, that is a common place where errors get quote unquote hidden. And so when you're reviewing this month's bank rec, one of the things you want to see is that those outstanding items from the prior month are actually clearing through. The other thing that I would strongly recommend then is that the person doing the bank rec do some sort of a documentation that they've reviewed it. Now, if you're doing it digitally and you don't have the software to add your initials on the report and the date on the report, then some sort of a log to be signed off saying I've reviewed the bank rec as evidence that you've actually looked at it, and on sort of what sort of timely basis. Was it done, you know, immediately, or did you do 6 months worth at once? Because that is sort of the point of the bank rec, is to give you a chance to correct errors as they get identified rather than correcting them a year later.
Stella, we did have just a couple of thoughts at
Okay.
on that slide.
Okay.
We had one comment that sometimes it's difficult to get all the signatures verifying a purchase and the balance of them paid on time when you have board members sign the checks, because I'm guessing the board members don't come in regularly. We kind of have them coming in twice a month, so it's very important. So if something very important is missed, it has to wait, and that can also cause issues.
Okay, we'll talk about that on the next slide then.
Okay, great.
So were there any other questions that relate specifically to the reconciliation process?
We do have one that is, things are kind of moving over to electronic funds transfers.
Yep.
So any thoughts on that?
Yeah, I'll be talking about that on both the payments angle and the receiving angle.
Okay.
Yeah. So on the purchase and payment approvals, like sending money out the door, again, policies and process need to be clear. So for example, if you have a program manager that is responsible for budgeting his or her program costs for the year, that person should then also have the authority to make purchases. And so, you know, let's say they're budgeting a school lunch program and they go, okay, we're going to, for 10 months of the year, we're going to have to buy 1 case of fruit a week or whatever to feed these children in our school lunch program. And so that person who has prepared that budget to say we need to spend $10,000 this year on fruit, needs to have the authority to then order fruit. Now, it might be within parameters that you only allow to purchase from approved vendors. But at the same time, they shouldn't have to go up the chain then for authority to place an order. And so have clear policies, and I would recommend linking the responsibility and authority, the responsibility for budgeting with the authority to make the purchase. Now, the other thing I would think is that person should also then be coding and approving the purchase when the invoice comes in, because they know which budget line they put the fruit into. Was it into program materials or into food costs? Well, that one's kind of obvious, but anyway, so rather than expecting the accounting department to guess which budget line this item is in, the person that made the purchase should say, hey, I meant for that to come out of my supplies line, because this was an unusual, we don't usually buy fruit. We did this week for some special activity. And so that's really not a food cost, it's a program supplies cost, something like that. So the other thing on purchases and approvals that's very blurred is the approval to purchase an item and the approval of the purchase when it comes in is separate from the approval to pay for it. And so the reason I say that is the payment approval is part of the cash flow management process. And so just because program manager A ordered that food, got the invoice and says, yes, we did in fact get 10 cases of oranges, not 9 or whatever, or wait a minute, this invoice is for 10, we only received 8. So I'm going to approve payment of 8, or mark the invoice approved, except for the amount was wrong. Then it goes to accounts payable, they enter it, and then somebody else decides if it's going, when it's going to be paid. And so that involves things like, how often do you do a check run? And so if you're really clear on timing of when how quickly these invoices move through the process. So you may say, that your program manager has to turn those approved invoices around in 2 days or 3 days or something, because if they don't, you're going to end up in situations like was asked in the question, where you also have to do a bunch of one-off checks because the invoices were slow and the vendor is bugging you for payment. So, oh, you've got to pay this. We forgot, we missed this. So by having a very clear and consistent pattern of when things get done that keeps moving them through the process, it allows you to have fixed points at which you do payment runs. I said check runs, that's, it could be EFT payments. And so, use the cash management functions of your accounting system, whether that's QuickBooks, Sage, or whatever you're using, is we've got our payables, everything is entered. These are the checks that are due this. And when I was in charge, I would always not just do, these are the checks that are due. My staff and I did our check runs on every 15th and 31st. And so employees knew by when they had to have their expense reports in if they expected to be paid. And I would do on about the 12th, we do the check run for the 15th, but I would capture in it all the vendor invoices that were due, not just to the 15th, but maybe to the 18th. And then pick from that list who is going to get paid. And so we were always a few days early in our payments, so that if I didn't have a partner, or in the case of a charity or a not-for-profit, didn't have a board member available who had to sign the checks, that we would rather pay a few days early rather than risk having something come out late. And so the solution to those one-off checks, those, oh, we don't have a check signature available, nobody's available to come and sign checks, is planning ahead. I know you're sort of shaking your head and go, Stella, you don't know what you're talking about. I've been there in a management position, and with good processes and clear policies in place, I think, so I managed the finances of an accounting firm for 5 years. And the number of one-off check signatures we ever had to do is maybe one a month, where we had not anticipated somebody having to be paid immediately. So my controller and I had a process in place, and it flowed really, really clearly. The other thing we did we paid as many of our vendors on EFT as we could rather than issue checks. So we would run 2 reports. One is, here's a list of checks that we're planning to issue. And then here on the same day, here is the vendors that we're going to pay on with EFT. And so we would take the one set of checks to someone for signing, and then the other report, the approver would sign as though it was a check. So they'd have the backup. So if you have a check, you give to, the treasurer for signing, the treasurer needs to see the backup for it, or the expense report or the invoice or whatever. We would also attach those to the EFT run so that they would have the backup, then they would sign it. And then we would have a process to make sure that the controller would run the EFT batch, and then I would log into the bank and release it, which was effectively like the second signature on a check. So there are processes you can put in place around EFTs that are very similar to check signing, but they require that you use your accounting software the way it was designed. Okay, let's look then at controls around deposits and revenue. So this is less common, of course, but some organizations still handle cash. So you'd want a policy around how often do you make deposits? Do you do it on a schedule? I would not want money sitting around for more than a week generally, but some organizations have so few checks and cash that it might make sense to have it less often. But how often do you make deposits? If it's sometimes you have a policy, if it gets over a certain amount, like if we have more than $5,000, we get accumulated. If it's less than that, then it goes in on Friday or something like that. And then of course, how is it locked up in the meantime? If there's cash involved, so an organization that, maybe that accepts a housing program of some sort, accepts cash for rent, they would want to get that cash into the bank immediately. That might have to be done daily. And so a policy of how often to deposit that real money, so to speak. When you're getting e-transfers, I would distinguish between 2 types. So there's the kind that we talked about on like the business to business e-transfers. We talked about when we were talking about making payments, where you set up an EFT process. And so those are generally not at risk. The kind of controls I would put on those is, that the contributor. So like a lot of government grant organizations don't want to send you a check anymore. Obviously, they want to transfer the money in person or into your bank account directly. So that means that somebody has to give them their banking information. So controls around who communicates with the contributor's payment department, and where does that banking information stay in the organization? Where do the notifications come? When payments come, do they go to the program? You got your quarterly advance, or do they go to accounting? Again, there is not necessarily a right and wrong. What you need is an understanding of who gets that information and what happens to it next. The type of e-transfer that is at high risk is some organizations. And this became a huge issue during COVID, when people stopped meeting in person, stopped visiting organizations in person, programs went online that used to be in person. you know, particularly I think in terms of like religious organizations stop having in-person services. And so people would be making their donations using that thing that we do. Well, they didn't quite go to Venmo, but going to I'll just email my donation in to, you know, to the secretary. And so those person-to-person kind of email transfers, I'm going to call them email transfers. It's run by Interact, so Interact transfers. Those are at a very, very high risk of loss and theft and fraud and so on, and going to the wrong place. So I may be a bookkeeper somewhere and someone sends me an email transfer, and instead of going at charity.ca, they send it to, you know, Stella at charity.ca, they send it to Stella at gmail.ca or .com, and I get it to my personal account because I've set up my personal bank to accept e-transfers without a password. And so it's really, really important that you think about where the risks lie, because if you don't have those coming in directly to a given email address, then the person getting the email can decide to put it in their own personal bank. They choose, where do you want to deposit this? Oh, I'll just put it in my bank. So there's some really basic controls. One is, don't take e-transfers if you can possibly avoid it. Secondly, stipulate an email address such as accounting at or payments at, that all of them go to the same email address. Ensure that a minimum of two people have access to that email address. And then figure out a way to follow up so that that second person who has access to that is actually checking up to see whether those deposits went into the bank. So that is a high risk area, no question. This one I've already talked about a little bit around hiring and payroll. You want to make sure that you have a process in place where employment changes are documented, not just, you know, the boss coming and telling the bookkeeper, oh, Sally got a raise. No, okay, I need a written memo telling me Sally got a raise. When did she get it? How much is it? You know, when does it go into effect? Another control that I really like is using an external payroll service. The costs are really quite moderate for the benefit you get as far as reduced errors and increased accuracy and ease of auditing. I speak as a former auditor. And then specific controls around financial reporting would be around who gets what kind of reports. So department managers might need sort of mini reports fairly frequently so that they can see where they are in relation to their budget. Senior management perhaps less often and more aggregated, less detailed. And then finally the board, the least often and the most aggregated. You also need to have policies around who keeps track of all of those program reports that need to go to external funders, external contributors. If there's lenders, how often do they need financial statements and who's going to send them? And so have policies around who's responsible and who's going to make sure that these things get done. The last group of specific controls that I want to talk about or just remind you about, won't spend any time talking about it, is just, again, have a clear understanding within the organization who is responsible to make sure that all of these legal requirements are met. Program reports to the funders. If there's tax filings that need to be done, which tax filings does our organization have to do, and who is going to look after it? Again, as an auditor, as we got a new client, we would find that, okay, are we doing the T3010 or are you doing it yourself? And they go, we don't know who did it last year. They didn't know. And, in some cases, it turned out they were never done. Things like annual returns for the Societies Act. And so just have a list of, here are all the regulatory filings we have to do every year. These were ones that Stella is responsible for. These are the ones that the treasurer is responsible for. And then sign off every year when it, oh, and this is when it's due. And then the last area of control, because it affects everything, is budgeting. The biggest advantage to budgeting as a control is it forces you to plan ahead. If budgeting is being done right, it will force you to plan ahead. And when I say plan ahead, I'm not talking about, well, let's just take last year's budget and add 2%. I'm talking about saying, okay, what activities did we do last year? What are our priorities for next year? What are those activities going to cost us to complete for the next year, and where is the money coming from? And then keep reiterating that until you have a balanced budget. And so if you do that planning, then when you do your actual to budget comparison, now you have a plan that you're actually monitoring, as opposed to just spending of money that you're monitoring. And the example again, you know, my employee had not fulfilled his plan. Great, he saved some money, but he hadn't done what he was hired to do. And so using budgets can be so important in so many different ways. A lot of organizations have, when the budget is approved, that means that program managers now have the approval to spend the money. In other organizations, it doesn't mean that. Or there may be exceptions. You can spend anything that's in the budget up to $5,000. Anything over that has to go to your boss for pre-approval. So understand what budget approval means in terms of approval. The other thing it can help you, hey, this is where we're putting our money. This is where our priorities are. And then it provides you with this basis to monitor not only finances, but actions. So just to recap, think about what is your role in the organization and who are you responsible to? And that includes everybody. The board is responsible to sort of society at large and to their funders in their fiduciary responsibility. So know what your role is, who is accountable to you for financial matters, and who are you responsible to in turn. Does your board get the financial information you think they need to see where you are, where you're going, and what your priorities are? Do you have some of these basic financial policies and controls in place, both entity-wide and specific to activities? And are you using budgets effectively in your organization? So that's what I would encourage you to reflect on. So with that said, for our questions, I'm going to go back to this slide.
Great.
And before we start with the questions, I just want to mention, if I feel that the question is very, very specific or very, very narrow to a particular organization, it might not fit within a general session like today. Sometimes people ask me questions, but they're not aware that, and I may not be aware that I actually need more information to answer the question. So some of them may be more suitable to a consultation. So I ask your indulgence if I say, you know what, I can't answer that one.
But yeah, so first one is, what kind of documentation would we make for reviewing the bank reconciliation?
So the bank reconciliation itself is the main document. And then, like I said, if I were the person reviewing it, I would also want to see last month's bank rec, and then of course the bank statement itself. And it's less critical now, like more checks are not, there's fewer checks being written, but I like to see the bank statement that has the canceled checks attached. And then as evidence that I have done the review, there's a number of ways that can be documented. So depending on what kind of software you have, so like I have a PDF software that I can write on a document. So I just put my initials right on the main bank rec, you know, my initials and the date I reviewed it. So that's one way of doing it. There's document management programs. So for example, Great Plains has a companion document management process that are module add-on that you can get. And so in that kind of a software, this is more sophisticated than just making initials on a document. The document is sent to a person and it comes with a virtual rubber stamp, if you will. And then the person, once they have done whatever they need to do, whether it's approve an invoice or review a bank rec, they then electronically or digitally sign off that they have done their step. So those are two ways. A third way I've seen of doing it is where the organization uses like a shared server folder. Could be done SharePoint or something like that, where there is just an Excel sheet in the folder. So the bank recs or documents are stored in the folder, and the person goes into the Excel log and initials and dates that they've done something. If you're using digital initialing in an like with the document management process or that software, only the person who is the person can add their own initials. If you're just doing it like quote unquote manually, but on a digital record, I have a very clear policy. And again, I get this from an audit firm. We had a very clear policy. No one ever types my name except me. No one ever types my initials except me. So that if I've typed my initials in there, that means I've seen the documents. So staff, don't be helpful and pre-fill my initials into a document, please. So there's different ways of doing that virtual sign-off.
Should there be a special controls for e-transfers for salaries or benefits?
So that question arises, there's sort of several aspects to that. So if you're using an external payroll service like PowerPay or ADP or one of those, then there's usually a preliminary report that you can produce that either, again, can be printed or PDF'd that someone can approve before the person who does the actual payroll hits submit. So in that case, I wouldn't also approve the e-transfer because the whole thing has been, you know, the whole relationship with the Ceridian has been approved in advance. And so the person approving that run is basically approving the payment to the employees and the withdrawal from the bank account. If you're doing payroll internally and approving transferring the money to your employees as, you know, 10 separate payments to 10 separate employees, then I would have the person who's approving the payroll. I would also then produce like what I call the check run report, but it's an EFT run report, and have the person who's approving the payroll not only approve the payroll, but also make sure that this net agrees on the planned EFT run. So there's different ways of handling that for payroll. For other EFTs, if it's a recurring one, like where you're paying a fixed monthly amount for a service, that only needs to be approved initially. Or if it changes, so like if you're paying for your phone bill through EFTs, but then it's an automatic withdrawal, that doesn't, I don't think, need to be approved every month.
Okay, great. And I know you mentioned Ceridian. Do you have any other recommendations for external payroll services?
I only mentioned Ceridian and ADP because they're the biggest ones. There are others that, quite honestly, don't come to mind at the moment because those are the two that I currently work with on clients. So I'm retired from auditing and I just do a bit of consulting for a few clients. And so I'm thinking some words in my head, but I don't know if I'm remembering the names of these other organizations. Payworks, I think.
Yeah, we use Payworks. I really like the user interface, actually.
Yeah, so those are the three that I'm familiar with. I'm not saying that there aren't others that are good.
we have a specific issue. If we push that both signatures had to be on the coding slip, the bill could be paid quite late as the timing during the pandemic and everyone working from home. And so our process works great if everyone is working in the office every day, but falls apart when someone's on vacation or not working in the office. I know you touched on that, but yeah.
So on the issue, let's just look at the issue of people taking a leave, whether it's vacation or being off sick or whatever. That is, if you go back to the concept of controls around segregation of duties. So I didn't mention this at the time, but I'll mention it now. One of the philosophies or principles of segregation of duties is that there should be no job in the organization that someone else doesn't know how to do. And so one of the big red flags for potential fraud that auditors look for is somebody that never takes vacation, because that means that no one ever has a chance to do their job and therefore maybe catch mistakes that they've made or fraud, but also mistakes. So my advice on that kind of thing would be, if a person is taking known time off, then you plan around that and say, okay, well, while you're gone, Stella, Liz will do the payment processing. Or while you're gone, you know, if you're a program manager, while you're gone, your assistant will approve the invoices. And to have that somebody to step into your shoes when you're away. The working out of the office, I mean, organizations had to find different ways of resolving that. And in my observation, in many organizations, things became more timely, not less timely. They actually figured out processes to move things along digitally that went more quickly than moving things along from office to office in a paper folder. So I would just suggest that just reviewing expectations, reviewing policies and procedures, reorienting staff to new ways of doing things. And this is how we're doing things. And rather than trying to adapt paper processes to a virtual scenario, is sort of tear it apart and rebuild it. Because, okay, in the first few months, we thought it would be a month, 2 months maybe, and then we'll be going back to work. And then we fell into patterns. But for those organizations that realized early on, this is an opportunity for us to learn to do things digitally. And we're going to sort of go back to the drawing board, and they actually improved their processes. I'll say one last thing about that. Be careful when you're changing processes. What you're doing is not just adding more steps. Like whenever you're adding a step, go, wait a minute, is this supposed to replace a step? Like, can we take something else away? So things that used to be approved twice, you know, once for purchase and once for payment, we're now getting approved 3 or 4 times. Okay, that needs to be revisited. So that would be, I would say, like 2 years in, it shouldn't, that virtual versus in-person probably shouldn't be an issue for things like payables and financial reporting. For things that require face-to-face with clients and so on and so forth, obviously that's still a problem. But for administration and finances, you may just need to develop a new process. Just to remind people that this session is generic and may not apply to specific situations that you find yourself in. And so just to be clear that this is a broad overview and not specific advice to your organization.
And beyond that, we do offer some consultations. Those can look like short conversations or 1-hour problem-solving sessions called clinics between one of our IntegralOrg experts and your team. These consultations are all free and just part of our mission to educate and support Alberta nonprofits. You can find out more by visiting our website or contacting our main number. And if, say, that your organization does need more in-depth help with something like a risk management policy or even financial policies, or we're available for organizational development projects customized to your specific needs. Great. Yeah. And then we just, at the end, maybe this is something that we fashion up later and send it out, but we did have some people interested in example financial policy templates, or even a list of financial policies that you should include.
Yeah, that's beyond the scope of today's session. So I would encourage you to reach out to IntegralOrg and just say this is something that you would be interested in. Like Liz said, we are looking at other topics for future and more in-depth webinars. And developing resources that can be made available to clients or organizations. Sorry, I still think in terms of clients. So just, yeah, if you put that in your survey or reach out directly and say, hey, we'd really need some direction on developing financial policies, the IntegralOrg can definitely help with that, either through a consultation or even maybe a clinic if it's quite short.
Yeah. Okay. Well, that's everything that we do have here. And I think that really wraps up what we can cover from this intro session as well.
Okay,
Yeah.
Thank you very much. And I'm sorry I went a few minutes over, but these are just topics that I feel very passionately about.
Yeah. Thank you. Yeah, if you guys, thanks for joining us, and we hope to see you guys again.
Bye, everybody.